Welcome to the New Dentist Study Club podcast. My name is Dr. Sanj Mohanta. We're going to learn about clinical management, practice management, and the emotional management of dentistry. Let's learn how to be happier in dentistry. Let's go. Thank you to our sponsors, Altum Dental Lab Group and RDT Dental Lab in Toronto. Hello, everyone. So grateful to all of you for joining in again. We have a very special podcast with my friend, Atul Mehra, who's an accountant. And we first met in Grenada a couple years ago at night under a full moon, under the moonlight. And we were on a dental outreach mission trip with 1000 Smiles, which is organized by Great Shape. And just to let you know what a good guy Atul is, he's on the board for Great Shape and has done several dental outreach trips. And I'm so excited for Atul to be with us today because he's an accountant and he's going to give us fantastic tips on how we can save money. So welcome, Atul.
Thanks, Sanj. Thanks for having us on the program and on your podcast, and looking forward to sharing our experiences. And yeah, Great Shape has been expanding our program throughout the Caribbean, and we had a serendipitous meeting out there in Grenada, and it was great that we were able to continue working with your group here and the new Dental Study Club, and looking forward to giving you guys some good information on what's happening on financial tax and accounting for dentists.
Thanks, Atul. And thanks also for sponsoring the New Dentist Study Club social nights. And yeah, I'm going
Hmm.
on another dental outreach trip in a couple of weeks to the Bahamas with Great Shapes 1000 Smiles. So we can give some information about that, like with podcast notes, so that if you're interested in volunteering, please join us in 2025. So, Atul, tell us everything we need to know, starting from being a student to retiring, how we can save money. So first of all, tuition tax credits. Tell us about that.
Wow, a lot of dental students when they graduate, they do have a lot of tuition credits that they've accumulated through all their years of studying. So, this tuition credit program is sort of like a coupon that you get, like a discount off your taxes. So the
Mm.
government essentially gives you 15% of the tuition credit off on your taxes. So, for example, if you had $100,000 of tuition credit through your school, you'd basically getting a $15,000 coupon against off your taxes. So, sort of fixed
Wow.
amount. Hmm. A lot of people think that, hey, if I have $100,000 of tuition credit, that if I make $100,000 of dental income after I graduate, then I don't have to pay any tax. But that's not necessarily the
Mm.
case, because the amount that
Okay.
you get is a fixed coupon. So you're not necessarily getting, uh, no taxes for that first few years that you're working, but you do get a significant holiday and credit on those amounts, because there's a significant amount of tuition that's accumulated, especially for people that have done their undergrad for 3 or 4 years, and then they go to dental school, and then some people do their masters as well. So they have accumulated, few. Some people have 150, $200,000 of tuition credit. So it does become a significant benefit for people. And the other thing about tuition credit that comes up a lot is it has to be used right away. So it's not something you can sort of save and like say, well, I'll use it later. A lot of people think I'll use it later when I'm making more money, but because it's a fixed amount, it doesn't really matter if you use it for the first dollar of money that you're making when you first start working, or if you make it later on in your career. It's the same amount of credit. So it's I sort of make it analogy, if you're going to a store and you have a coupon and you're like, it's 15% off. It's just like, it doesn't matter how much you buy, you're still getting the same fixed amount discount off your taxes. So, but it's important to run the numbers and know how much tuition credit you have. We do see a lot of cases where people uh, have filed their taxes while they're in school, and they've not included the tuition credit on their tax return.
Mm.
So it's important to go into the Canada Revenue's the online portal, and you can log in as an individual through a program called My Account, and see how much tuition credit you actually have. And they actually have a
Okay.
chart there, and you can see every year how much tuition you've actually claimed. And if there's any gaps in there or any missed amounts, you might want to make sure that that information gets sent to the government so that all your tuition credits are up to date.
Oh, great. Thank you. Now, Now that the dentist has graduated, they have to pay off the student loans. So what are your tips on that?
Well, we like to get those loans paid off as soon as possible. Now,
Okay.
the interest that you pay on the student loans is deductible as long as you're paying the loans to the government. So that's another issue that does
Mm.
come up because a lot of people, what happens after they graduate is they'll get a call from the bank, and the bank will say, "Hey, look, I'll pay off your loan for you, and you can take the loan with the bank, and the
Mm.
interest rate might be a little bit lower, and it might sound like a good deal, but the interest that you pay to the bank is not deductible against your taxes, where
Oh,
the interest you pay to the
okay.
government is deductible against your taxes. So you have to kind of take a look at the information, take a look at the interest rate that you're paying to the government, whether you have an OSAP loan or another federally or provincially funded program that you're doing.
Okay.
You want to look at that and before you just jump and refinance with the bank. So there is a decision that has to be made. But we do like to get those loans paid off as soon as possible. Most dental students after graduation, after a year or two, that is an objective that they have to get those loans
Mm-hmm.
paid off. So we do promote getting that done because you want to make sure that you're moving on with other objectives in terms of your career and your financial planning, and you want to make sure those loans get paid off because it's a significant amount for a lot of people, and they want to make sure
Mm.
that they can start moving on to other objectives.
Now, when I first graduated, my only objective was to pay off my provincial student loan and my Canada student loan. So I wasn't putting money towards, down payment for a house and RSPs. Was that
Hmm.
a smart move?
Well, a lot of times with planning like that, you have to look at budgeting. And,
Okay.
budgeting is something that you got to look at where you got to look at where you're allocating your money and putting things in different boxes in terms of allocation of resources. And with looking at your objectives, a lot of people, when they graduate, one of the first things they want to do is they need a vehicle, or they want to buy a
Mm.
house, or they want to save for
Yeah.
a down payment on a property potentially.
Yes.
So there are government programs out there that can help departmentalize some of that money and put that into a budget. And one of the first things you need to do is sometimes just do a simple monthly budget where you just look
Okay.
at, this is how much I'm looking to make as a dental associate. The average collections is somewhere between 10 and 15 to $20,000, depending on the skill of the dentist and the level of
Mm-hmm.
dentistry that they have. But if you're looking at like $15,000 of monthly income, then you also have to look at,
Mm-hmm.
and collections, you have to look at your expenses. And
Mm-hmm.
if you look at 100 cases, you're gonna have 100 different budgets because people have different lifestyles and family planning and financial
Mm-hmm.
relationship situations and different allocations of shelter and rent and costs and depending what city they live in. So you really have to look at your own personal budget. And then you also have to look at, what are your fixed costs? There's certain things that you can't take out. You may have to say,
Mm-hmm.
look, I have to have a car to get to work. I may need a cell phone or internet to do my CE and do my business of dentistry. There's continuing education that you have to take care of in terms of budgeting. Maybe you have to look at other costs like um, your RCDSO fees and your ODA fees and things
Mm-hmm.
like that. So there's certain costs that you're like, okay, I have to departmentalize that, and I can't really do anything about. And then you have other costs which are variable or discretionary, and those are the ones that it really depends. And people have different lifestyles and travel, whether it's entertainment. And depending on their objectives, and then you have to look at, well, based on all that, how much money's left over, and how am I
Mm-hmm.
going to allocate that toward the debt payment, taking care of the student loans, and maybe looking at maybe having a plan to allocate those resources to other things such as down payment for a property or down
Okay.
payment for a car or looking at saving for a particular thing like maybe some people after they graduate they're interested in maybe doing specialization and they want to save again
Mm-hmm.
for more education. So it does become very personal and customized, but I
Okay.
think it's important during the first few phases of your career to have that budget. And if you have those sort of habits built in at the beginning of your career, they will help you later on in your career when you get into more complex planning, when you're looking at maybe buying a practice or
Mm-hmm.
starting your own clinic or potentially other objectives that you have financially in terms of purchasing a property or a lot of times when people graduate they'll get married and then they'll have other uh, family planning costs, and so it does those habits of budgeting do help along the way later on in your career. So definitely something that you want to start practicing.
That's a good idea, a budgeting tool, which I don't do. Just because the money's in the bank doesn't mean you should buy that watch. So good
Well,
advice.
exactly. A watch could be an investment, but it's also your cell phone also tells you the time.
Yeah, that's true. Exactly. Now you
you
mentioned
know.
cars. Like, is
hmm
there any like tax tips you have, whether like leasing, buying, electric vehicles?
That's usually one of the biggest investments and
Mhm.
decisions that a lot of new dentists have to make because they have to find a way to get around. And a lot of them are studying, and they're if they're at U of T or Western, like in Ontario, for example,
Mhm.
they're living on residence or they're living close by at a
Yeah,
condo or a shared place. And as soon as they get their first job, they may be potentially associating at two different places at different parts of the city. So they're going to
yeah.
need a car. So it does come up a lot in our advisory, and it does come up with young dentists. And it's I've gotten calls from they're at the car dealership, and they're like, what's the latest deductible amounts available, right? So for cars, these days, with electric vehicles are hot with like Tesla and stuff like that, and but people are still interested in gas powered vehicles. So the government has given incentives for electric vehicles. So if you buy the car outright, which also means you're financing it. So let's say you get a loan and you also own the car, then the maximum amount that you can deduct is $61,000 plus HST, which
Hmm.
is about $68,900 if it's an electric vehicle. And this applies
Okay.
to all business owners, not only students. It could be any associate, even any area in their career. The same limits apply. So what happens if electric vehicle at $61,000 plus HST, which is 68,930? Those are the limits for 2025. So if it's a gas powered vehicle, it's $38,000 that you can
Hmm.
claim as a deduction against your taxable income. And so it's $38,000 plus HST, which is $42,940. So that's the maximum amount that you can claim as a eligible deduction against your taxable income before calculating your taxes. So if you're at the car dealership and you're looking to acquire a vehicle, and the purchase price of the vehicle is less than $38,000 plus HST, then you're going to be able to claim the maximum amount eligible as a
Wow.
deduction. Now, if you're at a Lamborghini dealership and the car is going to cost you $300,000, you can go ahead and purchase that vehicle, but you're only going to be able to deduct $42,940. So you're limited. Same thing with an electric vehicle. If the electric vehicle is, you walk into the dealership and they say, look, it's an $80,000 vehicle, that's fine. You can still buy the vehicle or finance the vehicle through a loan, but you're only going to be able to claim $68,930 as a deduction against your taxes. Now, that's if you
Okay.
buy the car. But if you lease the vehicle, which is another financing option that's available in a lot of dealerships, there's also limits on the
Hmm.
monthly amount that you can deduct. So for 2025, being a new year, we're 7 days in, so um, the limits are different. So it's $1,100 per month plus HST. So that's $1,243 per month is the maximum amount that you can claim as an eligible deduction against your taxes every month um, if you're leasing the vehicle. So the same concept applies if you walk into the dealership and they're saying, "Hey, look, this is the vehicle. The monthly cost is $1,500, and the maximum amount you can claim is 1,243, then that extra money above 1,243 won't be allowable as a deduction. It doesn't mean you can't proceed to, lease the vehicle. It just means that you're over the government maximum allowance, so you won't be able to claim the full amount of the cost. Now, if the vehicle is less than that amount, then you can claim the full amount against your taxable income. So those are sort of the government limits. There are also government allowances for the kilometers that you drive to and
Hmm.
from the clinic. So for
Okay.
those people that, for example, we've had some cases where they already have a vehicle. So they've already purchased the
Okay.
vehicle, and then they're just using their vehicle that they've had when they're an undergrad or when they're at dental school. So they, they already, and the car's already paid off. So the car's already been like
Hmm.
bought a long time ago. So they can still
Hmm.
claim the kilometers that they drive, and the government has prescribed kilometer limits. So they basically say it's
Okay.
72 cents per kilometer for the first 5,000 kilometers and 66 cents for any kilometers over 5,000 kilometers for the whole year. So basically, the government has prescribed these amounts, and that basically covers your gas, your insurance, your operating costs of the vehicle, maintenance, repairs, and things like that. So you don't have to necessarily keep track of all your costs. You just you have to keep track of your kilometers that you drive.
Okay.
So and then if you figure out, a lot of dental associates, they can easily figure out, because they know their home office is located at this location, practice A
Hmm.
is located in this location, practice B is located in that location, so they can essentially create like a grid for the year and then calculate approximately how many kilometers they drive and then prorate that over the year, and then apply the 72 cents kilometer limit or the 66 cents, depending how many kilometers you're driving, and then come to a number, and that becomes the allowable deduction on their tax return. So there's different methods and different options available for automobiles, and it's a significant expense for a young
Hmm.
dentist. When they come out and graduate, and they still have the student loan, but a lot of them do have a line of credit, which the bank maybe had given them 250 or $300,000 of line of credit, but they've paid some of
Hmm.
it down, or they haven't used all of it, so they still have access to capital. They just started working, and they're sort of comfortable that they're going to be earning, 10, $15,000 a month. They've still at a position, but they have these costs. So these questions of deductibility do come up because everybody wants to maximize their deductions and minimize their tax.
Hmm. Now, Atul, can dentists who are independent contractors claim their mileage and their car for driving to the office, or can it only be claimed for things like going to a patient's home for emergency or taking CE? So explain that to us.
Yeah, that's a big question that does come a
Mm-hmm.
lot, because a lot of
Mm-hmm.
people read articles and blogs about that you can't
Mm-hmm.
claim when you drive from your house to
Mm-hmm.
work. But the way the income tax is structured is there's two different divisions and sections of the Income Tax Act. One applies to
Mm-hmm.
business owners and self-employed individuals, and the other one applies to employees that are working at a company. In most
Okay.
cases in Ontario and most of Canada, when dentists are working at a dental clinic, they're not considered an employee of the clinic. They're
Mm-hmm.
independent contractors or associates because they've
Yes.
signed a contract, and they are essentially governed under the business division of the Income Tax Act, which applies
Mm-hmm.
to them as a self-employed individual. So essentially, they're acting as a business owner. So as a business owner or self-employed individual, the essentially when you're going to uh, like a office, like a clinic, you're essentially acting as a business. So it's essentially a project. It's like you're
Mm-hmm.
going to a project, and you've been asked to provide a service as a self-employed individual, and you are going to this project, and you may be going to another project on, you may be going to one project on Monday and Wednesday and Friday, and you may be going to a different project on Thursday,
Mm-hmm.
Tuesday, Thursday, and Saturday. So essentially, those project the travel to go to those projects is governed under the business expense category of travel and automobiles. So those amounts become deductible. So one of the things that becomes a little tricky is the pro rata element of this, because you may be working 5 days a week, let's say Monday to
Mm-hmm.
Friday, and then Saturday and Sunday you're off. So
Mm-hmm.
really, the only kilometers or the limits that you can claim are percentage pro rata based on the personal usage of the vehicle and then the business usage of the vehicle. Because
Okay.
because it's like, unless you're working 7 days a week and say, look, or you're working 6 days a week, and the seventh day you're like, look, I'm not working and the car is in the driveway, so
Mm-hmm.
I'm essentially using it 100% of the time for business. So it really
Okay.
depends on the person's situation. We've had
Mm.
cases where people live downtown. They have some associate positions where they take Uber to the position, so they
Mm-hmm.
don't use their car for that. So their
Or like I
kilometers
ride
are
my
low.
bike to one of my offices. So
you ride your bike, right?
Yeah.
Or you have other cases where people fly to, Yellowknife
Yeah, it's
to
true.
do a local, right?
Exactly.
And then they're like, hey, look, I'm paying for this flight. So,
Hmm.
and I'm going to Northern Ontario to Thunder Bay to work. And so they're
Yes.
paying for like a porter flight. So that flight becomes part of their deductible expense. So it is
Okay.
somewhat you customizable depending on the cases of, dentists are interesting careers, and they can be doing work in Toronto one day, they can be doing work in
Hmm.
Nunavut the other next day. So it's very
Okay.
interesting.
Okay, great. Thank you. So now we graduated, we paid off our student loans, we got our car. Now we want to buy a home. So
Hmm.
what advice do you have? Like, are there government programs for first-time home buyers?
There are a few
Okay.
programs and some new programs as well. So that's a great question because it does come up, and that's one of the next decisions that have to be made because it's like, where are they
Yeah.
going to live? Once they've
Hmm.
solidified a position, they want to be able to decide they want to purchase a property. So there's
Hmm.
four main programs. The first one is the home buyers plan. So the home
Okay.
buyers plan is connected to the RRSP program. So
Okay.
the RRSP program is a registered retirement savings plan. And that is a government program that incentivizes people to save money and also get a deduction against their taxable income. So
Hmm.
one of the things you need to, if you're a young dentist, is look at your notice of assessment or log into the online portal at CRA and obtain your RRSP contribution room carry forward amount, because some
Okay.
dentists have already worked like part time, or they were working
Hmm.
full time while they were in summer, and they may have accumulated some RRSP contribution room, because
Okay.
RRSP contribution room can only be accumulated from earned income when you're actually working, and it's a set amount, 18% of your earned income. So some people who
Okay.
have been working as part-time jobs, they may already have some RRSP contribution room. If somebody for some reason had not worked at all, and didn't accumulate any RSP room from up to the date of graduation, then they won't have any RSP room available. So, assuming how much room you have, the maximum amount that you can put into the home buyers plan is $60,000. So they've increased it to $60,000. So what that means is,
Okay.
if you have $60,000 in your registered retirement savings plan account, you can remove or withdraw $60,000 from the home buyer's plan, from the RSP, put it into
Okay.
the deposit into your home buyer's plan, but you still have to repay that back into the RSP within 15 years. So there's sort
Okay.
of this planning um, program that you need to look into if you're looking to buy a home. That's the first sort of program, the RSP
Okay.
and the home buyer's plan, sort of a dual program that's connected. The second incentive is there's a new one called the Home Buyer Savings Account, FHSA.
Hmm.
So that's a new program that just was launched a few years ago. So that allows individuals to make an maximum $8,000 deposit essentially into this account. So it's still your money. You're just
Hmm.
taking like $8,000, you're putting it, you're walking into the bank or financial institution, and you're making a deposit of $8,000 into this account. It's still your money, but you're able to claim an $8,000 deduction against your taxable income. And
Okay.
then when you purchase the property, you can withdraw the money from that account and use it toward the purchase of the property. So that's another program
Okay.
that's new that you should definitely look into. There's a lot of information available on the Canada Revenue Agency website. It's a relatively new program, but it's a maximum amount of $8,000 per year to a maximum of $40,000. So it's essentially
Hmm.
$8,000 times five, $40,000 is the maximum. So a lot of new dentists have started opening up these FHSA accounts because they're thinking
Okay.
about buying a property. And one of the benefits of the FHSA is when you put the $8,000 into the account, any income that's earned within that investment or product that you put it into, you can put it into a term deposit, a GIC, stocks, bonds, mutual funds. It earns interest, dividends, capital gains tax free during the period
Hmm.
that's in there. And when you remove the money, it doesn't get you're not taxed on that. So there's a sort of a holiday on that. So they're trying to incentivize young people to help them save money. So that's the second and third program. First one's the RRSP, the home buyers account. Second one is the FHSA, and the third program is the home buyers amount. So what that means is
Okay.
when you purchase your first home, the government gives you a $10,000 tax credit on your personal tax return just
Mm.
for the fact that you purchased a home and it's your first home. So that $10,000 credit is similar to the tuition credit that we talked about earlier. It's basically a 15% coupon on the 10,000. So it's basically $1,500 off your taxes. So they give you again another incentive to help you with closing costs or other costs of purchasing property that they know that people have. So, and if somebody's depending on their marital status, you can double up on a lot of these programs as well because the husband and the wife can both get these things. So it could be everything could be doubled up. It could be $60,000 for the home buyer's plan each, which would be $120,000, plus the
Mm.
$40,000 each for the first home savings account, so that'd be $80,000, and then $10,000 each for the home buyer's plan. So there's all these government incentives out there. You know, the other thing to also be mindful of is getting a mortgage and looking at getting a mortgage pre-approval and getting your checking your
Mm.
credit and things like that. So it's important to talk to a bank or a mortgage broker or financial institution and get a pre-approved mortgage so you can get an idea of like, what kind of house can you afford. And then
Mm-hmm.
while you're doing that, as part of, it's all kind of connected to the budgeting allocation of resources, and then you know how much you can afford. So that when you go out and looking for a property, you can sort of allocate. Okay, I can afford this much. There's no point in looking at a property that's over your budget. So it's
Yeah.
important to get a lot of these banks and financial institutions and mortgage brokers will provide you with a pre-approval. So they'll look at your financial situation and they'll say, look, based on this, you can get pre-approved for this much mortgage. And they can also provide you with a number of how much it's going to cost you to service that mortgage in terms of principal and interest payments. It's essentially like your rent. So you can use that and apply that to your not only your current budget but your forecasted budget after you buy the property. So all these things, can help.
Oh, great. Now, Atul, how about the difference between RSP and PFSA? Should we invest in both? What are the advantages and disadvantages?
I mean, a lot of times it looks at the objectives. If somebody's looking to buy a property, a new dentist will
Mhm.
usually push toward the RSP because it's connected to the home buyer's account.
Yes.
Sorry, the home buyer's plan. So that kind of integrates the two programs. So you get the deduction on the RSP side, and your objective of maximizing getting to that magic number of $60,000 of home buyer's plan amount. So once that's been achieved, then we may switch focus to a TFSA to complement that. So the difference between a TFSA and an RSP is a TFSA, you don't get a tax deduction on your tax return,
Mm.
whereas in the RSP, you get a tax deduction against your taxable income. So there, and the TFSA is not eligible for the home buyer's plan. So and a lot of times it depends on the objective because a lot of individuals they are not interested in purchasing a property, for example, because maybe they're moving or they're renting right now or they're living at home even in some cases. So they don't have that same objective of buying a property. So they may delve toward the TFSA on the basis
Mm.
that the TFSA is going to give them tax-free savings, and they're looking at maybe more. Their objective is to accumulate more capital just for investment purposes. So it's an
Mm.
important decision. But the other thing to look into is depending on the person's age, they have to look at their TFSA eligibility or contribution option because the program started in 2009, and it, depending on when you turned 18, the amount that you can contribute to the TFSA um, you know, will be determined based on your age.
Okay. And now, finally, we want to retire. Tell us about CPP, Canadian Pension Plan.
So CPP, it's a very complicated program. We started in the 1960s, and it was designed for the federal government to help people that when they turn, 60 or 65, to be able to pull money out to help them with their retirement. And the program is a mandatory program for self-employed individuals. So even if you're a dentist and you have hundreds of thousands of dollars of tuition credit carry forward, you're still going to have to contribute to CPP on your personal tax
Okay.
return. So, and the amount that you have to contribute is anywhere. It's almost $8,000. So the amount has increased significantly over the last few
Mm.
years because the government has a situation where there's an aging demographic in Canada, and there's more people over the age of
Mm-hmm.
65 than under the age of 18. So there's a push to finance all these people that are over the age of 65 that are pulling funds out of the CPP. So essentially, the Canada Pension Plan is a federally funded pension program. it's you cannot opt out of it if you're self-employed or you're an employee. You have to contribute to it. The only way to
Okay.
opt out of it is if you're not taking a salary, and potentially if you're an incorporated dentist and you're taking a dividend, and then you can opt out of it. But
Mm,
that's
okay.
some advanced planning that we do look at in certain cases.
Okay. Thanks, Atul. You gave us so many gold nuggets. Appreciate it. Now,
It's a
people
lot of
want,
stuff.
if people want to contact you, how can they do so?
So the best way is to go to our website,
Okay.
www.mnco.ca, and then my contact information is there and our team. And you can send me an email. My email address is there, or you can catch me on LinkedIn. We do try and post some information there about events that we're doing and participating in, and some tidbits on some tax updates. We do have a newsletter as well that you can register for on our website. So we have a quarterly newsletter that we issue to our clients and individuals that go on our website. So they can go on our website and get our newsletter. It's sent out every quarter. And then we also have some webinars and events that we post on our website as well. So there's some webinars on there that are for dentists, like if those are that are looking for more advanced things like buying a practice, or evaluation of a dental clinic, or even we have some budgeting webinars on there that we've done in the past. So it's a good resource if you're driving to the clinic and you want to listen to some videos. We've got some stuff, some content on there as well.
It's incredible that you're providing so much educational content. And I'm excited about your boot camps that are coming up in North Toronto. The next one's on March 26th. I'll send the information so that
Hmm.
people can register and learn more from you and your colleagues about, being financially, gaining financial freedom, which this is all about. And
Absolutely, absolutely.
we got to give a shout out to Great Shape, which
Hmm.
not only introduced us, but they're doing great work in the Caribbean with their dental care program, eye care program, reading program. And if you're interested in doing dental outreach with us in 2025, check out the greatshapeinc.org website at the beginning of February to get all of the dates to sign up. So we hope to volunteer with you all this year. Thank you so much,
Absolutely.
Atul.
Thank you. Thank you. Happy New Year, and thanks for having me. I look forward to hopefully seeing you in the Bahamas, or Grenada, Turks and Caicos, or at one of our seminars, our boot camp coming up in the fall and winter this year.
Thanks, Atul. Thanks for everyone for joining us. Bye, everyone.
Bye. See you.
This podcast is sponsored by RDT Dental Laboratory, your full service dental lab in Toronto. RDT Dental Lab will help you grow your practice through education, predictable restorations, and high attention to your clinical needs and patient experience. Check them out at rdtdentallab.com. Thank you for listening to the New Dentist Study Club podcast. Listen to us on Spotify, watch us on YouTube, share and subscribe, and follow us on Instagram at New Dentist Study Club.